If you're a complete beginner and you've been thinking, I want to invest, but I don't know where to start, this video is for you. Because investing doesn't have to be complicated. You don't need to be rich. You don't need to be a finance expert. And you definitely don't need to watch the stock market all day. Today, I'm going to walk you through how investing actually works, the safest way beginners should start, the biggest mistakes to avoid, and a real-life example of how to invest step by step. By the end of this video, you'll know exactly what to do with your first $100, $1,000, or even $5,000. Let's start simple. First, what is investing? Investing is putting your money into assets that grow over time. Instead of letting your money sit in a savings account earning almost nothing, you put it into things like stocks, index funds, ETFs, real estate, retirement accounts, and over time, your money grows because of compound interest. Compound interest is when your money earns returns, and then those returns also start earning returns. That's how people build wealth, not by working more hours, but by making their money work for them. Now here's the mindset shift beginners need. Investing is not gambling. It's not day trading. It's not buying random stocks you saw on social media. Real investing is long-term ownership of businesses. When you buy a stock, you're buying a piece of a company. For example, if you buy shares of Apple, you own a tiny piece of that business. If the company grows over time, your investment grows. That's it. Simple concept. Now let's talk about where beginners should start. Step 1. Build your foundation first. Before investing, you need emergency fund 3, 6 months expenses, no high-interest credit card debt, stable income. If you're paying 20% interest on credit cards, that's your first investment. Pay that off. Once your foundation is strong, now we invest. Step 2. Open the right account. For beginners in the US, you usually have 3 main options: 401k through your employer, Roth IRA, brokerage account. If your job offers a 401k match, take it. That's free money. A Roth IRA is powerful because your money grows tax-free for retirement. A brokerage account is flexible. You can invest anytime and withdraw anytime with access on names. Platforms like Fidelity Investments, Schwab Corporation, or Vanguard Group are beginner-friendly and low-cost. Opening an account usually takes 10-15 minutes. Step 3. What should beginners actually buy? This is where most people get confused. They think they need to pick the next big stock. You don't. The safest way for beginners to invest is through index funds. An index fund tracks the entire market instead of trying to beat it. For example, an S&P 500 index fund invests in 500 of the largest US companies. Instead of betting on one company, you own all of them. Historically, the S&P 500 has averaged about 8-10% annual returns over the long term. One popular ETF that tracks it is Vanguard Group's VU. Another is SPY. When you buy one of these, you instantly own companies like Apple, Microsoft, Amazon, and hundreds more. That's diversification that reduces risk. Now let's do a live example. Let's say you're 25 years old. You invest $500 per month into an S&P 500 index fund. Let's assume an average 8% return per year. If you do this consistently for 30 years, you would invest $180,000 total. But because of compound growth, your account could grow to around $750,000 or more. That's the power of time. Not luck. Not stock picking. Consistency. Now imagine starting at 35 instead of 25. You'd have 10 fewer years of compounding. That's why starting early matters more than investing big amounts later. Step 4. How to actually place your first investment. Once your account is funded, search for the ticker symbol. For example, UO. Choose how much you want to invest. Select market order for beginners. Confirm purchase. That's it. You're officially an investor. Now let's talk about risk. Investing is not a straight line up. The market goes up. It goes down. Sometimes it crashes. In 2008, markets crashed. In 2020, markets crashed. But long-term investors who stayed invested recovered and grew. The biggest mistake beginners make is panic selling. If you invest for the long term, 10, 20, 30 years, short-term drops don't matter as much. Volatility is normal. Emotional decisions are dangerous. Now let's build a simple beginner portfolio example. If you're under 40 and want simple, 80% S&P 500 index fund, 20% total international index fund, that gives you US and global exposure. If you want even simpler, 100% total market index fund. You don't need 20 stocks. You don't need crypto hype. You don't need day trading. Simple wins. Now let's talk about how much to invest. Start with this rule. Invest at least 15% of your income if possible. If that's too much, start with 5%. Increase every year. Automate it. Automation removes emotion. When investing becomes automatic, wealth becomes predictable. Common beginner mistakes. Trying to time the market. Checking portfolio daily. Investing without emergency fund. Following TikTok stock tips. Panic selling during downturns. Wealth building is boring. And that's a good thing. Now let's talk about realistic expectations. Investing will not make you rich next month, but over 20, 30 years, it can change your entire financial future. The goal is financial independence. The goal is options. The goal is freedom. And investing is the vehicle. So here's your simple beginner action plan. Build emergency fund. Open Roth IRA or brokerage. Choose low-cost index fund. Automate monthly investment. Ignore short-term noise. Stay consistent for decades. That's it. No complicated strategies. No guessing. No gambling. Just disciplined, long-term investing. If this video helped you understand investing clearly, comment below. First investment. And tell me how much you're starting with. $100? $1,000? More?